Alrighty, welcome to the third and final presentation of tonight. And if you're just joining this stream and haven't seen it before, so no, I'm not Andrew Stocks. I'm Alex, his business partner and co-founder of the Valuation Masterclass. But we'll take in Andrew and see what he's up to. What are you up to, Andrew?
I'm still stuck in traffic in beautiful Bangkok traffic.
Isn't it amazing?
Yeah, I was hoping I'd be home by now so I could be sitting in your seat, but I appreciate you doing this, and it is pretty fun though, don't you think? I mean, I'm really enjoying the presentations as always. So
Yeah, the students are making a great effort through these 6 weeks. Really hard work, and it shows in their final presentations.
yeah, definitely, these presentations, particularly considering that they all pretty much started from zero. To get to this point is pretty impressive. So it's a great, you know, like you said, it's about becoming a valuation expert in months rather than years.
Indeed. So I'll let you continue enjoying the bank of traffic, and then we'll pull in you a bit at the
Can't
end.
can't wait. All right. See ya.
Yash, welcome. We're
Hi
excited.
there. Yeah, I mean, a bit scared too,
So
but that's fine, I think.
you can just relax. I know you've done a great job with this report. So you will present your research on target, and
Yes.
what I will do is I will just turn off my screen and mute my microphone. So
Okay.
whenever you're ready, you just get started.
Yeah, let's just start right now. Okay, so I should start, right? So, target in for a potential upside. I initiate coverage on target with a buy recommendation based on target price of US dollars 208, implying an upside of 34%. I derive the target price from a DCF based valuation using a WACC of 10.5% and a terminal growth rate of 2%. Highlights are opening of 300 stores should drive revenue growth for years ahead. Turnaround sparks about 20% profit growth over the next few years, and e-commerce is the future catalyst. Some of the risks are impact of economic downturn on consumer spending, risk of inventory shrinkage, vulnerability to supply chain disruptions, and heightened cybersecurity risks. So, a bit on the background, Target has a significant market share of 4% in the US retail sector. The company's main revenue sources are beauty and household essentials and food and beverages, which together comprise over 50% of its sales. Target stands out with its substantial investments in technology and store enhancements, aiming to create a personalized shopping experience and improve operational efficiency. So, a bit on the stories. Expansion and e commerce are the blueprint for the growth. Opening of 300 stores should drive revenue growth for years ahead. Target operates 1956 stores, up by about 5%. This expansion has been mirrored by revenue growth, showing a growth of 38%. This can be seen because the company has made significant investments in transforming many of the locations into the stores with fulfillment hubs. In my opinion, Target's continued investments in store transformation are expected to increase the number of stores by 7 to 10% over the next few years, reaching around 2,100 locations by 2028. This could drive annual revenue growth by approximately 10 to 12%, potentially pushing total revenue to over US dollars 120 billion by 2028. Turnaround sparks about 20% profit growth over the next few years. Target has faced the dual challenge of expense control and revenue growth. In 2023, revenue growth was at 2%, at negative 2%, with a 2.4% rise in operational expenses. Target has improved a lot in the past 12 months for both profitability and growth, showing an overall 20% jump in profit growth. It can be seen because Target has been potentially dealing with inventory shrinkage and supply chain issues. If Target continues to address these issues, the company could see a potential 8 to 12% annual increase in operating profit over the next years. E commerce is the future catalyst. Target has made significant strides in embracing the e-commerce era, 18% revenue from online retail in 2023. The introduction of innovative features like drive up and order pickup in 2022 and 23 saw a 50% increase in usage. Target's continued focus on expanding its digital infrastructure and e-commerce capabilities is expected to drive sustained growth, positioning the company for a potential 25% annual increase over the next few years. So this is the industry analysis, the digital dominance in the food and staples retail industry. Digital transformation fueling an increase in the growth of online grocery sales. The industry is witnessing significant changes driven by e-commerce and technological advancements. For instance, Grandview Research reported that online global retail sales were valued at US 7 trillion in 2024 and are expected to grow at a CAGR of 7% from 2021 to 2030 with an estimated value of US 13 trillion in 2024. Food and staples market is projected to increase at a CAGR of 3.7% to reach US 16 trillion by 2030, almost double CAGR in the online retail. Multiple competitors increase the price competition and industry dynamics. The industry faces growth constraints due to fierce competition, price sensitivity among consumers, and high regulatory compliances costs for smaller retails. Other significant challenges include high logistics and fulfillment cost, continuous investments in technology, and substantial customer acquisition expenses. Advancements reshaping supply chain logistics to promote higher profits. To prevent disruptions, businesses are now using several suppliers and keeping larger inventories to increase visibility and planning. They are making significant investments in digital technologies. These initiatives support the management of problems arising from environmental elements like climate change and geopolitical issues like conflicts, which have an impact on food pricing and production. So Target in financial year first quarter 25 saw a drop in revenue margin. Target's revenue decreased by 3.1% year over year, while gross margin slightly increased by 1.3% year over year. And for the consensus estimates, over 50% of analysts hold a buy view on Target, with 12 analysts issuing a buy and 8 analysts issuing strong buy recommendation. The mean target price indicates a potential upside of 12%. The consensus predicts a significant increase in revenue growth from negative 1.6% in 2024 to 4% in 2026. For the revenue structure, the largest revenue contributor is the beauty and household essentials segment, which makes up to 30% of the target's total revenue. Following closely is the food and beverage category, accounting for 23% of the overall revenue. Target's corporation operates 1956 stores and 58 supply chain facilities, showing a consistent increase from 1868 stores and 42 supply chain facilities in 2019. This growth reflects Target's expansion efforts of opening 300 additional stores over the next decade, underscoring their commitment to expanding and supporting revenue growth. So this is the fundamental valuation momentum risk. It's a framework. Target's corporation rank best among 1830 non-financial companies in the USA, placing in the top 10%. Fundamentals have ranked in the first quartile because of the asset turnover averages around 200%. Valuation metrics show stability with a price to sales ratio of 0.7%. The EV to EBIT ratio stands at 14, reflecting a moderate valuation. Momentum has been challenging, with revenue growth recently declining by 2%. While risk metrics are favorable, Target's low beta of 0.2% indicates lower market volatility. This is world-class benchmarking. Target Corporation ranks in the top 3 for profitable growth among 950 larger consumer discretionary companies. Both the profitability and growth have been in the top 30%. However, challenges in revenue growth and expense control persist, impacting the overall performance of for growth and profitability. Despite these hurdles, Target has consistently shown strong results in profitable growth due to asset efficiency. Additionally, the company has significantly improved in the expense direction. Here is the profit and loss statement. You can see that revenue is declining a bit in 2024, but after that it's growing, and the EBIT margin is growing throughout. As the balance sheet asset side, here the inventories have fallen because of the shrinkage, and they have been increasing after that. And net fixed assets are going to increase in the forecast. And here is the liabilities and equity side of the balance sheet. Here's the cash flow statement. Ending cash is going to be constant for years because of their investments. And here are the further ratios. And I am taking FCF to form for the calculation of the company's valuation. For relative valuation, PB multiple, Target looks cheaper compared to the consumer staple sector in the US. The relationship between Target Asia and the global markets highlight that Target is expensive. I forecast its return on equity to be around 33% in 2025, higher than the sector average in Asia, the USA, and the world. If we look at the chart, we can see that Target stock is undervalued, thus making it relatively cheaper stock to buy in the sector. For the PE multiple, Target trades at a discount compared to US, Asia, and global markets. Target's PE is expected to decrease to 13 multiple in 2026. Target appears undervalued on PE basis, but despite the recent EPS decline, Target's strong recovery outlook makes it attractive. But using the 2025 PEG ratio to value Targets highlights that Target is undervalued. So target valuation, target price. I assume a risk-free rate of 3.5% and a market equity risk premium for the US market of 9%. Target has a beta of 1, leading to a cost of equity of 12.5%. I anticipate a capital structure with 20% debt to total capital, resulting in a WACC of 10.5%. After accounting for debt and other obligations, the equity value per share is projected to be US dollar 208 based on the FCFF model. Here's the sensitivity analysis. And for the main risks are consumer spending and inventory shrinkage, impact of economic downturn on consumer spending. In January 2024, it was highlighted by CEO Brian Cornell that American consumers have been resilient and unpredictable. As Target saw massive sales in 2021 coming in from discretionary categories, even in times of pandemic. This was a way to control this. Increased risk of inventory shrinkage. The CEO revealed in an interview with CNBC that 9 stores in the region were forced to close in 2022 due to theft, and the company as the shrinkage has increased in recent years. Efforts to combat this, including enhanced security measures, may not fully mitigate the impact, leading to potential financial losses. Vulnerability to supply chain disruptions. Target's global supply chain is susceptible to disruptions from natural disasters, geopolitical events, and transportation bottleneck. Such disruptions could delay the availability of products, increase costs, and negatively impact sales and customer satisfaction. Heightened cybersecurity risks. As Target continues to expand its digital presence, the risk of cyber attacks increases. Potential breaches could compromise consumer data, disrupt operation, and result in significant financial and reputational damage despite ongoing investments in cybersecurity. So my coverage is upside of it, and here I end my presentation. Thank you so much.
Well done, Yash. So let's start with some questions from the audience. The first question we got from Sharvi, and the question is, Target has many strong competitors, so how is Target innovating to differentiate itself from competitors?
So let me just go back to the slide 1. Yeah, slide 2, sorry. So here you can see that they have been opening fulfillment hubs, and also e-commerce. They have been trying to do their best, like drive up and order pickup, and also they have bought a shipping service in 2017 which is shipped, and because of that the service for the Target consumers have increased, and they are delivering the products in just one day, which even Amazon cannot do right now.
Thank you. So let's take a couple of other questions. We have a question here about the e-commerce contribution. Can you comment a little bit on how much is currently contributing and what you think about the future?
So here I highlight that 18% revenue from online retail is from 2023, and this has been constant or even increasing. And uh, like I can say that Target has been constantly innovating and increasing their sales in digital market, and has been taking some efforts to open digital supply chain facilities.
So I think this question is maybe two in one, but the question is about the inventory shrinkage, which is one part, and then there's stores that have closed down. Can you
Uh,
comment a bit on if Target has any strategy to mitigate the loss from the closed down stores?
Inventory shrinkage has been a problem for Target, and they have been mitigating these issues. Like in 2022, 9 stores were closed because of that, and even in 2023, some of the stores were closed because of that. They haven't yet disclosed that. But what I'm thinking is they are strategizing. Like in the annual report, they have mentioned that they are going to open some supply chain facilities there in place of the stores, so that they can get on the digital sales instead of just retail sales. So that's the strategy for going ahead.
Alrighty, so I think Andrew might have a question here.
Um, so I guess can you go to the front page to the first page? Um, so I'm just looking at this, and I'm looking at uh, why is it that Target is trading at a I think a much lower multiple than what we've seen with Costco and at least Costco, if not Walmart also. Why isn't this company? I mean, it seems like a pretty well run company. Why isn't it trading at a higher multiple?
So Target is a smaller company than Costco and Walmart. So here you can see just it's a significant market share of 4% in the US retail sector, while Walmart has 26.6% of market share in US retail sector, and Costco has 10% of market share of in US retail sector. So that might be the reason.
Okay, okay. You can stop sharing your screen.
Oh, yes.
So, how does it feel to graduate from the Valuation Masterclass Bootcamp?
It actually feels quite good right now. I've been looking at the screen for so much that I don't. As I was looking at my screen for 7 8 hours, I had to use that. So I'm free for this, but I want this for later too. Like I love this right now. The thrills of just working on the company.
Yeah, I mean it's such a fun thing, and when you become a professional analyst, you're looking at the company over and over for years until you really know it so well. But you did a great job for the fact that you've only had 6 weeks to learn about it. Actually, five, right? Because you didn't learn about it until the fifth week. How would you describe your transformation? How would you describe what's different about you now compared to when you started?
I think my leadership skills have grown because like I take meetings by myself now. I don't think like if people are not taking initiative, I should take the initiative. And also I am more confident. Like if someone in the meeting is not presenting, or if someone is saying that I cannot, I will take the initiative to do that. So that has been one of the major skills I have developed in this boot camp.
Yeah, it's been great watching you develop, and I appreciate your contribution, your questions, your you make yourself a part of this community, and that's what I really want to see out of every student. So, congratulations on that, and also congratulations for finishing the report and a great presentation, Alex. What do you think?
Well done again. I mean, as I mentioned before, it's very tough and challenging 6 weeks, but it's amazing to see how much our graduates can achieve in that short amount of time to go from, in many cases, zero to making these great final presentations. So, well done.
Thank you so much, Alex.
Alrighty, so thank you, Yash and Andrew. I will let you enjoy the Bangkok traffic. And this is it for tonight, everyone. Thank you for joining and thank you for asking questions. Tomorrow, on Thursday, August 15, we will have four presentations coming up. So we're talking in Bangkok time or Indo-China time, or also known as GMT plus 7. At 6 p.m., we will have a presentation of Chevron. At 6:30, it will be Shell. And at 7 p.m., it will be BP. And at 7:30, it will be Exxon. So we will look at the energy sector tomorrow. Like today and yesterday, you'll be able to tune in via LinkedIn. Just go to Andrew Stott's profile and you'll find these events. You can also go to YouTube, the Valuation Masterclass YouTube channel, and you'll find these streams under the live tab, where you can also make sure to get the notifications of when we start. And finally, the Valuation Masterclass helps you become a valuation expert in months rather than years. And to learn more about our next bootcamp, which is Masterclass Bootcamp number 7, you can just visit our website, valuationmasterclass.com/bootcamp. So again, thank you for tuning in, and we hope to see you again tomorrow.